Hey everyone, before I jump into today's topic, I want to remind you today is January 15. And if you're watching this video right now, it's probably past January 15. So you may have already blown through this deadline. But remember, January 15 was the deadline for the previous quarter. If you have already paid the IRS enough money in advance throughout the year, this does not apply to you. But this is mostly for people who are self-employed and have rental properties or have income from other sources where the taxes have not been withheld. If it's past 15 today when you're watching this video, you can still pay it, but the penalties are going to start adding up. It is better to do that now versus continue to wait around on it. Do not call us or click the link below if all you want to do is complain about your massive tax bill. Tax bill is the outcome of your actions throughout the year. It also reflects how your tax advisors are and how committed they are in helping you. Let's be clear, we don't have a magic wand. No one's got the magic wand. There is no special rule for the wealthy. They all follow the same tax code, and no, they don't cheat the system. They just know better, and they are strategic about it. And they have people in their team that understands the tax code, and they use the tax code to their advantage. Real tax strategies require specific actions, and those actions must be taken throughout the year, not just during the tax season. Your tax plan covers steps that have to be taken throughout the year, but the results are reflected over the years and year over year. The tax bill is just showing you how well you're stacking your finances, netting you a 6% or a 7% tax bill, or maybe none. April 15 is not no strategy. April 15 is just your report card. It's possible, if you follow exactly what we recommend, it is possible for you to cut your tax bill in half, at least less than what you're paying currently. And if you are aggressive enough, you could potentially eliminate your tax bill for the future years. Click the link below to discuss this for free, but only if you're ready to take action and not complain. So today I attended an IRS continuous education webinar, and there was some really important information that came out of that webinar. I would like to share that with you. The one big thing they wanted to talk about was the Form 8867. This form is the backbone of what your tax preparer is filling out when they are preparing your return. If the tax preparer is not asking you detailed questions every single year about their filing status or their dependents or education credit and household situations, that's a red flag. They're supposed to ask you this question every year because it can change from year to year, and it comes in very useful when it comes time for you to claim some credit, and they are very critical for them to enter them correctly and report the IRS. Form 8867 is the due diligence form that paid preparers must complete and file with your return if you are claiming certain credits or your filing status changes. So what does this Form 8867 actually covers? It covers earned income tax credit, the child tax credit, the additional child tax credit, the American Opportunity Tax Credit for education expenses, and head of the household filing status. These are big dollar credits that can significantly reduce your tax bill or increase your refund. But here's the thing, the IRS holds your tax preparer accountable for verifying that you actually qualify for these credits. That's why your preparer needs to ask you questions about who lives in your household, who you are supporting financially, and whether your kids are in college and what education expenses you are paying for them. Now here's what you need to understand. These requirements change every year. The rules, the penalties, the income limits, the verification requirements, they all get updated annually. For returns filed in 2025, the penalty for a preparer who doesn't meet this due diligence requirement is $635 per failure. That means if your preparer fails to properly verify your eligibility for all of these 4 tax benefits, they could face up to $2,600 in penalties on just one return alone. So when your preparer is asking you these questions before the tax season even starts, they are not being nosy. They are protecting themselves from massive penalties and protecting you from an IRS audit. So the bottom line is, if your tax preparer is not asking you these detailed questions about your dependencies, your filing status, and your education expenses, and your household situation every single year, you need to question whether they are doing their job properly. Form 8867 is not an option. It is a requirement by the law. And if your preparer isn't completing it correctly, both of you could be in trouble with the IRS. If you have any questions about this or need help making sure your tax preparer is meeting these due diligence requirements, reach out to us at d2tax.com. We stay on top of these requirements every single year because it's our responsibility to get it right.